So, since Monday, the 26th of May, Cardano has dropped down by 11.92%. Now, this is pretty much in line with the rest of the broader market and in line with our expectations. But obviously, we were not expecting the price to drop as far as it has gone. Let me go and walk through what we were talking about in the last technical analysis session. So in the last session, we were looking for a short position, obviously, which we had entered up here on the Z wave high, which now looks like a pretty good entry point. We actually had a couple of entries here. So we could have been locking in profits, re-entering, locking in more profits, bouncing up. Again, seeing more weakness in here. So had we actually been paying more attention yesterday, we potentially could have even entered short off of the rejection here from the 200 hourly EMA. And even, after seeing that, the resistance on the 50 EMA and 50 SMA, we probably could have entered on this candle here around 1300 hours yesterday and really captured this move to the downside. So, it's in line with our kind of short expectations, but what's not normal within our parameters of what we've been tracking on the 1 hour time frame is the depth of which this has gone. It's obviously been led by BTC. Okay, so Bitcoin has pulled the entire market to the downside. And there's a few things here that I think we need to kind of acknowledge. I don't think we are necessarily out of the woods just yet. So let me go ahead and break down what I think the macro picture here, or say slightly macro picture, looks like. So you can see that we had a swing high up here on Friday last week, 0400 hours, that we then moved down. We bounced up into the Z wave and then we've moved down again. Now this is kind of reminiscent of the kind of typical kind of structures of what you would expect to see within those parameters. Let me go ahead and draw this in using the fib tools, pull this down to our Z wave bounce, and here you can see that we'll be looking for 64.98 to 67.24. And that is going to basically be our kind of typical area of expectation within a larger A, B, and C structure. So I'm going to leave this here, then we're going to work with the smaller structures to see whether we really get confluence. Okay, so if I zoom in on this, we can see this particular move to the downside is looking rather scary, right? Here we can see the potential for a diagonal. Here we can see that we did not pierce the higher, so that would be your wave 2. Then you have a wave 1, 2, 3, this being 4, 5, only to complete out the wave 3. Let me go ahead and see if that stacks up using this move right here. Okay, so if we measure this distance using the fibs, move it over to the bounce, here you can see that we do cross 1.618. So anyone who's familiar with Elliott wave will know that 1.618 is the Fibonacci equivalent of a trend. Okay, so from an Elliott wave point of view, when you hit 1.618 times the first wave, it basically means you're trending in that direction. Now this is a 1 hour time frame. That means we are trending to the downside on the 1 hour time frame, and it's nested inside. So let me show you what I mean by that. Okay, it's like Russian dolls. Okay, so you would expect to see 5 waves inside your wave 1, 5 waves inside your wave 3, 5 waves inside your wave 5, right? In this particular case here, we are still looking for this move to the downside, right? So it doesn't look like it's complete. And all of that is nested inside a wave 3 position. So we'd have your wave 1, your wave 2, all of this being wave 3, 4, and then 5. And then so as you can kind of see, this brings us right the way down into this lower ranges. Now, what are the typical kind of expectations? Well, wave 4 retraces 38.2% of this move here, which is already kind of done, as we can kind of see. Now, if I go ahead and actually run this in the opposite direction, from the up to the downside here, you can see that it has come right up to 38.2%. So it's already kind of met those kind of expectations of what a wave 4 would do. And if we kind of put this back up here, you can see that this then kind of gives us a wave 3 between 1.236 and 1.618. That would basically be 66.79 to 67.81 cents. Okay, that then completes out your wave 3, meaning that you would end up with another wave 4 situation, but this time that wave 4 comes from a bigger area. It starts at the top, comes down to around that kind of, let's say, 66.5 cents, which means that we would expect to see this wave 4 bouncing out towards 70 cents, finding resistance and then coming back down. If that happens, of course, we're talking about 66.5 cents, so somewhere around here, up towards that 70 cents area. Then we're going to be looking for 64 on the low side and 65.6 on the higher side. So basically, volatility is going to be the name of the game here on the Cardano chart. Now, is this going to play out beautifully well, perfectly, and as per our expectations every single time? Not necessarily, but if we again look for confluence here, we have this swing low at 64.26, and there's the potential here for a much larger three-wave pattern. Okay, the three waves again being wrapped up inside kind of like a W, X, and Y pattern. Let me go ahead and take that to the swing high that we had at 86.43, move that over to here, and you can see that we would be looking to try to hold the 66.05. Anything lower than 66.05 puts this into the territory of W, X, Y, X, and Z, like what we saw over here most recently, and potential for more slippage. But we want to see this swing high, or swing low, sorry, of 64.26 hold, if possible, in order to kind of stay a little bit bullish on the market. But outside of everything that we see here, it isn't actually all that bad, right? It is in line with the expectations that I've been talking about with Cardano since we failed to hit $2.26 back in January. That was a pretty key and pivotal point for Cardano, and the failure to hit it basically meant that we were going to be seeing a lot more of these pumps and these dumps in the market. So it is in line with those expectations, although very frustrating for retail investors. It is a part and part of the trading process here. So let's go ahead and take a look at some of these indicators then. Our stochastic RSI here is actually up in, or at least heading up towards the overbought area. That basically means that we're riding into that fourth wave with momentum, and we might start to see a bit of a shift to the downside to complete out its fifth wave. That actually would line up quite nicely with an oversold stochastic RSI on the 4 and 8 hour timeframes, meaning that we actually see a bit more of a relief rally back to 70 cents. So we're going to keep a close eye on that and see how that kind of plays out. On the 4 hour time frame, you can see that it is only just down here. We can spend a few more hours down there for sure. Okay, so interesting stochastic RSI. What about the relative strength index then? Well, the RSI is still in bearish territory, and it hasn't really gone up terribly too much, indicating that momentum is still quite bearish at the moment. There's no major movements going on. We're below 50. We're in bearish territory as we kind of approach the overbought area on the stochastic variation. So again, it's kind of one of those. And from our MACD histogram, and as I was talking about previously, we were looking for either a kind of breakout to the upside or a breakout to the downside based on what we are seeing here with a lack of appetite from the buyers and a lack of appetite from the sellers. Okay, and here we can see that sellers have actually kind of got a couple of scenarios here where most recently they have, of course, taken control of the situation. Now, the good news is that this is still a higher low, and if we zoom out far enough of this, we can still see that even with an increase in selling pressure here, the zoomed out view still looks like consolidation, so lower highs and higher lows. So that basically shows weakness still on both sides of the argument, but we do of course have to move the trend line from where it was to where it is right here. Okay, interesting kind of things, but that's why I don't like trend lines, because they are just, you know, you can just move them around and change your perspective as you kind of see fit. Now, the good news is that what we've got going on is actually, you know, a lower low on price action, but a higher low on the MACD. Okay, that's an indication of bullish divergence. So we're getting some bullish divergence on the hourly time frame from the MACD histograms. We can see that the stochastic RSIs on the 4 hour and 8 hours are also in pretty decent positions, but I still expect us to see a little bit of volatility. Now, where do we get the kind of breakout situations that we kind of want to be keeping an eye on, right? How does this bearish pattern break? Well, the bearish pattern here breaks if we actually see a rally higher than the previous wave one high point or low point here. So any price action above 73.24 cents breaks this bearish pattern that I've drawn out, and we can get confirmation of that by breaking higher than obviously the swing highs of the wave 1 and 2, but also a little bit early indication at around 74.34. Okay, so we're going to keep a close eye on the wave ones, both of these wave ones that I've drawn here, because they are an indication that this pattern that I've drawn is not what is playing out. Okay, so always understand where your invalidations are, where your perspectives needs to change, and how that sentiment in the market can flip like a switch. So for now, we're bearish, but you know, we know some clear lines in the sand where things kind of change. Okay, cool. So let's roll this up into a daily time frame then, because all of that noise on the smaller time frame, is it really making a splash here on the daily? And to be honest with you, we're still within the B wave pattern. Okay, now the daily time frame, the most recent breakdown, the retest of the 200 exponential moving average is the concern, right? Because the 200 EMA, seen from a lot of kind of traditional kind of ways of looking at the market, would be your kind of trend filter. Close below it, and of course you're going to be bearish. Close above it, and you're going to be bullish. Now, we closed yesterday, a few hours ago at the point of recording here, above the 200 exponential moving average. Then we've kind of come down lower. So if today's candle closes above the 200 EMA, well, we're still in a very bullish territory then. Okay, the 200 EMA at the point of recording is at 72.17 cents. So anything above that could be a pretty strong position to say that we might actually have bottomed out here. Of course, we are still looking for those lower targets though, 64.97 to 67.23, unless there's something that changes within the data. All in all though, this is just a B wave pattern, and 64.26 is our A wave origin down here. So that's kind of what we want to see hold in order for us to push out to these higher ranges. Now, like I said before, the lower that B wave goes, the lower that C wave goes. Okay, so they do relate to each other. They're in relationships to the A wave. So C wave is going to be between 1 and 1.236 on the fib scale in relative scale to the A wave. So the lower that B wave goes, the lower that C wave goes, right? Because you move that measurement across. So in that particular case, which we were looking for 94 cents to $1.02, we are losing those higher levels the lower that the B wave goes. Okay, but it's still bullish nonetheless. Some pretty good areas. Now, of course, like I've been talking about for a while, here we do have some interesting things to kind of keep an eye on. Okay, so one of the things that we need to kind of keep an eye on that's quite important is that bigger kind of back row move to the upside, which is a part of a three-wave pattern. Now, that three-wave pattern is going to be made up of multiple different things. Now, we could be looking for diagonal patterns which contain three-wave patterns, but actually build up into 5 by the time you get to a macro scale. And they can actually also be contained within A, B, and C three-wave patterns. So it's kind of like Russian dolls, right? Inside each of the candlesticks, by the time you go down the time frames, you end up with different structural points. And each of those can tell you a piece of the bigger picture overall. So although you might not be able to see the full picture on the daily chart at the moment, the smaller time frames kind of builds up to that, towards that picture anyway. And if I zoom out far enough on this, we do have a multi-year A, B, and C structure. The C wave, we're looking out between some of these key areas. On the low side, it's $3 to $4.77. On the median side, it's $5.27 to $12.91. And on the bullish kind of hopium side, it's $38, which we don't really talk about. Now, for us, a C wave pattern has to contain 5 waves. But we can see here that we have an ABC structure and correction, meaning that this is more than likely going to be a diagonal pattern that's actually going to take a little bit longer to play on out. Not that I can time the market. Now, with that, we have to consider that that would then mean that we would end up with a three-wave pattern in wave 1, 3 waves in wave 2, 3 waves in wave 3, 3 waves in wave 4, and 3 waves in wave 5. That's 5 3-wave patterns. That means that there are going to be 10 moves up and 5 moves down on a kind of daily time frame, and on a smaller time frame, it's going to be absolutely all over the place. And so volatility is going to be the name of the game. I know I've spoken about it before, and I've keep kind of trying to hammer that point home, is that we have all of the accumulative zones that have hit in the past, so in 2022, we call the 22 cent low. Okay. From there, we have the first distribution event, right? Well, actually, we had the first accumulative event between 23.42 and 28.87 if you had missed 22 cent. Then we have the distribution event that happened between 53 cents and 85 cents. Then we go into that next accumulative range between 27 cents and 42 cents, and probably the one that most people will remember. Then we go up into that recent distribution event between $1.01 and $1.37. Obviously, we hit 132. And then we have that next accumulative range between 27 and 53 cents. Now, we've tapped lower than 53 cents twice. There's no guarantee that we go down again, okay? Just because it has happened in the past does not mean that it's going to happen again, but we have tapped into that range, right? And it's been a great area for accumulation, right? So it's possible that we still go down, but I do think there's actually a higher possibility that we actually don't go down into those depths between kind of, 53.95 and 27.5 0.25. But I could be wrong. But for now, that is the cumulative range that is scoped out. There's a few additional ones that we spoke about on the smaller timeframes. But for the most part, everything here is still on track. And it's likely to take quite some time to play on out, which is going to test retail patience, which is something that retail investors don't exactly have in abundance. So be cautious, be aware that this market is going to be punishing a lot of people who are expecting kind of, instant gains, within 24 to 48 hours, and is going to reward those who have patience. But of course, everything is still set. I'm going to continue to update everybody every kind of 48 hours or so on the price action of ADA. So do make sure to subscribe and like the video if you want to see more of this kind of thing. And for now, that's going to wrap up today's video. If you found it useful, smash the like button, subscribe if you do, and I'll catch you in the next one.